I'd like to introduce Blackrock Mining to you. In talking about what we're doing at Blackrock, we are as soon as I get this going. We're there, good. We're a graphite development company in Tanzania. We have one asset, and we think that asset is the best undeveloped graphite project on the planet. And what I'd like to do is take you through the logic about why we think it's the best undeveloped graphite project. We're ranked number 4 in resources, a bit over 200 million tonnes, which is certainly a large volume which to base a mine plan. We've completed the pre-feasibility study, and the pre-feas gives us a reserve of close to 70 million tonnes at about 8.5%. We, in the last 12 months, as well as completing the PFS, we've managed to restructure our board to a development-centric board, and we've cashed up now to complete the DFS which we've commenced. Our Dfs Contractor is CPC Engineering. CPC comes to us on the back of having completed Syrah's Balama project. So what we've done is matched the best capability we can find in the market with the project. So where that leaves us at the moment is the PFS. The business model we're using on that is what we call crawl, walk, run, and that is we go in with a single module producing 80,000 tonnes of concentrate, and we cash flow that concentrate into a second and a third module. It gives us around about a $90 million investment capex, and at the end of the day we come out with about $220 million US EBIT. So a compelling investment story. What I'd like to do is actually pull the cover off a few of the graphite projects and try to explain why we think our project works best. At the end of the day, two things matter in this space, and that is CapEx and OpEx. Using the bootstrap model, and I've taken everybody else's models here, and where they have bootstrapped, I've applied the bootstrap, so it's a like-for-like comparison. We come up with the lowest capital intensity, peak capital intensity. So we get more bang for buck. I think that's the bottom line you describe it. And clearly you can see the OpEx divides into two clear groups. So it's CapEx and OpEx is what defines investment, simple as that. I think if you're going to be competitive in this space, you need to be sub 400. The next thing is if we start looking at resources and reserves. Now, resource is reasonably easy to add in the graphite space. It's not a rare mineral, there's a lot of it. And all we need to do is drill a few holes along strike and we very easily convert material into resource. The challenge is converting it into reserve. So what we're able to do here is we're ranked into number 4 in resource, number 2 in reserve. But what's particularly important here is you can start to see that there's around about a line that says 6 to 8%, and that's sort of like the Great Wall of Graphite, in that if you're going to have a low-cost business, you need to be above 8%. It's as simple as that. When you get into 6%, you start to have a lot of throughput in your plant, you have a big earth-moving effort. So when you're looking in this space, 8% is the magic number. And, you know, 8% using a basket price that's credible should give you about $100 a tonne recoverable value. This is perhaps the real money shot, and the reason I talk about absolute strip ratio is we spent a fair bit of time doing the wrong thing, which is trying to crank up the cut-off grade. And with a graphite project, we tend to have a flat tonnage grade curve. You crank up the cut-off grade and all you do is push your strip ratio up, and that starts costing you money very quickly. So the way to look at a graphite project is you look at what I call absolute strip ratio, and that's simply tonnes, your head grade times your recovery times your strip ratio. And that really talks about the amount of tonnage you need to move to produce a final tonne of product. And again, you can see that there's a group of people there, a group of projects of very high strip ratio, predominantly low-grade projects that just simply are going to struggle. We then normalise that because we all talk about flake size and compare this to the weighted average flake size to your concentrate grade. And what we're really saying here is we have a unique product at 98.5 to 99.5% graphite that is just not available on the market. Importantly, we're able to produce quite a lot of that. What it means from an offtake point of view is I'm not trying to have a price shootout with Syrah, who are the 900-pound gorilla on the block. We got something different. And from my point of view, where we see it is we may be a price taker depending on where the market ends up. We're most certainly not going to be a volume taker. We will always be able to sell high grade. I'll take this to the next step, which is quite simply comparing the basket price versus the weighted average price. And what we're really talking about here, you can see a fair dispersion around the hypothesis that increasing basket size is equivalent to increasing value, but there's a fair degree of scatter on that. And one of the feedback items I've had every time I attend an investment conference is, will you graphite guys please get honest with the price? So what I did in that next slide is I simply applied our price deck to everybody else's production profile. It's a wrong number, but it means we're universally and collectively wrong by the same amount. And you can see that it really does tighten up that distribution. And I'm sorry, but the Forrest Gump, I'm special, doesn't work. We tidy that up in the final shot here, and this is really the message I'd like to leave you with. And it's simple as this, is it's about margin. We're not at the bottom of the cost curve, but we've got the highest grade concentrate, and we've got a decent flake size. That translates to a decent selling price. Normalise this and you can see what we end up with, the lowest capital intensity and the best margin for any mine of a meaningful size. Why does meaningful size matter? I'll just leave you with the thought that the 2028 Toyota Prius does 50 kilometres less on a battery charge because they changed graphite supplier. It ain't going to happen. When somebody buys into your product, they want more and more and more of the same. So a key barrier to entry is the capacity to scale up your production and produce lots of the stuff. And that's pretty much where we're at this space. So I'll wrap that up very quickly. What are we going to be doing next year? Where we are. We've just completed a 1,800 metre infill drill program, which is going to effectively defines the first 5 years of production. We've completed a 500 tonne bulk sample. Customs officials are on site this week sealing the bags. We're going to put it on the railway and take it out via rail, both of which are pretty novel in Tanzania to finally get the rail system working. We've got a pilot plant for 140 tonnes that already sits in Canada. We're going to run that in late February, early March. That's going to give us the engineering design data for the DFS, as well as product that we can put in front of pre-qualified customers. Second pilot plant is August, September, 500 tonnes, and that's about following up our pre-qualification work. It's also about validating the engineering design coming out of the DFS. We think the DFS should be completed somewhere around Q3, Q4 this calendar year, and from there we move into feed. All things lining up, we should be in production around about the end of calendar year 19, which is a pretty fast burn rate, but the execution model I think supports that. So, consistent with an engineer trying to do things on time, on budget, I'm going to finish a minute early, delivered in full, ahead of schedule, and thank you very much.